Okay, students, let's start the revision of the last topic, which is consolidation. Today, we'll be discussing few basic areas of consolidation. So obviously, I'm going to conduct more than one classes. The entire aim is to basically revise each and everything of consolidation, including question on the new pattern. Okay, inshallah, so that you can have the chance to see in the live revision class how to solve the question, and you can obviously ask queries then and there. Consolidation. Just a minute. That is group accounts. Obviously, we know that consolidation or the group account means to merge the financial statement of different entities. When do we start preparing group accounts? When one relationship creates, the name of the relationship is there has to be one parent and another company is going to be a subsidiary. In order to become a subsidiary, the normal understanding is if parent gets more than 50% ordinary shares in subsidiary, then parent will have the control. Okay. For example, if parent is having 80% holding in subsidiary, then it means NCI is having 20% holding. Fine. We have parent, let's say we have S1, S2, and S3. This is the one possible group structure, which is called a simple group structure. There's another possibility as well. For example, we have parent having, let's say, 80% holding in S1. Let's say S1 is having 60% holding in S2. Very important concept. Obviously, parent is having 80% holding in S1. It means parent in S1, parent holding is 80%, NCI holding is 20%. Okay. Now, S1 is having 60% holding in S2. If S1 is having 60% holding in S2, so obviously S1 logically controls S2. S1 logically controls S2. The concept is if your subsidiary, obviously S1 is a subsidiary of parent. The concept is if there is any subsidiary of your subsidiary, like S2 is a subsidiary for S1. So it means we can say that S2 is sub-subsidiary for parent. So basically, if your direct subsidiary is having a subsidiary, that is also the subsidiary for the ultimate parent. So we simply say S1 is your direct subsidiary. You can say that S1 is your indirect subsidiary, even though if you calculate effective holding of parent in S2, it will be less than 50%. Like P and S2. If I calculate effective holding, so we'll take 80% of 60. Let's see what it is. I'm getting 48%. Interestingly, the effective holding of parent is 48, but an NCA is having 52, but still the control is with parent. Why? Because the concept is if your direct subsidiary is having a subsidiary, that will also be the subsidiary for the ultimate parent. And always remember, students, in exam, we are always supposed to perform group accountings for the ultimate parent. Another possibility, in the last possibility, let's say parent is having 80% holding in S1. S1 is having, let's say, 40% holding in S2. So obviously now S2 is not a subsidiary of S1. So right now, obviously, if S2 is not a subsidiary of S1, so S2 cannot be a subsidiary of parent. But what parent does, parent says, okay, if this is the case, let's do this. Parent directly takes 30% holding in S2. If parent directly takes 30% holding in S2, now, if you look at the relationship, parent obviously 80% holding, NCA 20% holding. Now, if we calculate, look at the relationship here. Now, if you calculate the parent's effective holding, So you will take 40 into 80, but in addition to that, 30% holding. Because parent directly is having 30% holding in S2, which means that I'm getting 62% holding. So NCA is 38. Now listen and listen carefully. Now, due to effective holding more than 50%, S2 becomes indirect subsidiary of parent. There's a difference between this group structure and the first one. In the first one, S2 was a subsidiary for ultimate parent because the logic was S2 is a subsidiary for S1. Right now, S2 is not a subsidiary for S1 at all. Due to parents' direct holding of 30%, an effective holding of 40 and 80, the combined holding has become more than 50. That is why S2 has become indirect subsidiary for the parent. Okay, now go ahead. Now, group account means consolidation means that we merge the financial statements of different entities. Different entities means parent and its subsidiaries. It could be one, it could be more than one. Okay. Now, basically, when we solve a consolidation question, so there's a one simple approach which we normally follow in FR, even we do follow in SBR as well. That's a simple approach. First, you need to know what are the steps to solve a simple consolidation question. Then slowly and gradually we'll bring more topics into that. For example, in SBR, one is you should know all, I would say 5 steps of consolidation. That is basic. Second, you should know the topic that is disposal of shares in a subsidiary. Disposal of shares in a subsidiary. What if we start selling our holding in a subsidiary? Then how to deal with that? You should be able to deal with step acquisition. Actually, step acquisition means acquisition of a subsidiary in stages. Step acquisition means acquisition of a subsidiary in stages. Okay. Now, look at this disposal of shares in a subsidiary. If we can sell some of the holding in subsidiary, so there can be another opposite topic. Opposite topic could be parent can acquire further holding in subsidiary. So if parent gets further holding in subsidiary, so how to deal with that? Parents acquires further holding in subsidiary. How to deal with that? Your subsidiary could be an overseas subsidiary. In case of foreign subsidiary, how to do the group accounting? And never forget group cash flow. So these are the areas actually which you have to have a really good grip. Okay. When we talk about these 5 simple steps of consolidation, the first step is you should be able to identify the group structure. Identify the Now listen and listen carefully. Basically, identifying the group structure means you should be able to identify what is the holding of parent. In, let's say, if there are 2 subsidiaries, so what is the parent holding in subsidiary 1, subsidiary 2? What are the holding percentages of NCA? If there is any associate, so what is the holding of parent in associate? So step 1 is just identify the group structure. Means you should be able to find out the parent's holding in, let's say, S1, if you have S2 as well, parents holding in associates. Okay. We know that associate and joint venture, the accounting is same. Concepts are different, but the accounting is same. Okay. This is step one. Step two. Actually, in step two, what do? We basically calculate the net. We need to just perform another, I would say, step in which what do? We just calculate net asset of subsidiary at acquisition and at reporting date. Now, when I'm calculating net asset of subsidiary at acquisition at reporting date, this will be done for each subsidiary, because in SBR, it is possible that you are having more than one subsidiaries. So step two, net assets of each subsidiary. Net assets of each subsidiary. At acquisition. At acquisition. At reporting date. Post acquisition. Step two is net asset of each subsidiary. And we very well know that actually net assets means total asset minus total liabilities. Can I say total asset? Total assets minus total liabilities, they are equal to net assets. And we know that basically net assets are equal to equity. So if someone is just putting the heading of net asset and under that heading, I'm using all the items of equity, that's perfectly fine, because net asset, they are equal to equity. So we actually want to know the status of net asset of each subsidiary at acquisition, at reporting date. Obviously, the difference is going to be the post acquisition. So let's say I'm assuming, just ignoring 3 zeros if it is required. Otherwise, data could be in millions. Share capital. Listen and listen carefully. Actually, in share capital, you will not find any difference at all. It will be same at acquisition, at reporting date. No difference at all in share capital. No difference you will have in share premium. Because what happens, I'll tell you, after parent gets control in subsidiary, subsidiary is not going to issue shares. Because if subsidiary is going to issue the shares, then obviously those shares parent will have to subscribe. Try to understand, if parent does not subscribe those shares, then automatically parent's holding will be diluted. So that is the area which is not examinable. So you should not be worried about that. So you will have the share capital of subsidiary at acquisition, at reporting date same. Share premium will be same if it is there. Most of the time examiner does not give you the share premium, but if it gives you, so there's no harm to write share premium. Other component of equity. It could be revaluation, for example. But if examiner gives you other components of equity, now there's a possibility that you might have a difference in other components of equity. There's a possibility. There's a possibility revaluation at acquisition is different, at reporting date it is different. So there's a possibility that you might get a difference in other component of equity. So there's a possibility. Okay. Definitely you will be having a difference in retained earnings. There's no doubt about it. Retained earning at acquisition, retained earning at reporting date, and you will have a difference here. It could be positive, it could be negative. For example, try to understand. If it is 100, it is 120. So mathematically it is coming negative, but logically can I say retained earning, they have increased by 20 million. So you have to write positive. Repeat. If the retained earning at acquisition is 100 million and at reporting date it is 120. So obviously there's a rise of 20 million. If it is 80, then we will say there's a loss in the retained earning. I hope this is clear. I'm just using the examples so that you should have an idea. Logically, it is 20 positive. Okay, now another possibility, that is fair value adjustment. Most of the time you will have this fair value adjustment. Assuming we are having a fair value adjustment in property, plant and equipment. I'm just putting the values. Let's say 50, 50, 0. Since there's a fair value adjustment in property, plant and equipment, so we have to calculate additional depreciation on fair value adjustment. Additional depreciation on fair value adjustment. And that additional depreciation will be deducted from here, assuming it is 10. So repeat, if there's a fair value adjustment, which you will be having most of the time, obviously in the question. So let's say it is 50, 50, but obviously it is fair value adjustment in the property, plant and equipment. So you will have to calculate additional depreciation. Additional depreciation on fair value adjustment will be calculated according to the remaining life at acquisition. Assuming additional depreciation is coming 10, so it will be 10 will be deducted from net assets at reporting date. And then we'll be having a negative impact in the post acquisition as well. Okay. What else? There's a possibility that you're having a fair value adjustment in land, non-depreciable asset. Fair value adjustment land, it could be non-depreciable asset, assuming it is 20, 20, no difference. Okay. Now, another important point, very important point. What is that? There's a possibility that subsidiary has sold stock to the parent. Repeat. There's a possibility that subsidiary has sold stock to the parent. Now listen carefully. If subsidiary is the seller, then you will have to deduct unrealized profit. Unrealized profit. It could be unrealized profit on a stock. It could be unrealized profit on property, plant and equipment if there is an intra-group trading between parent and subsidiary. But make sure we'll deduct the unrealized profit if subsidiary is the seller. If the subsidiary is the seller. And you will deduct this from here, assuming it is 5. Repeat, unrealized profit could be on a stock, unrealized profit could be on machinery, but please, it will only be deducted if subsidiary is the seller. That is very important. So basically, unrealized profit on a stock, unrealized profit on property, plant and equipment, machinery will only be deducted if subsidiary is the seller. Then you will get net assets at acquisition, net assets at reporting date, and you will get a difference in the post acquisition. Whatever it comes here, whatever comes. Okay. Now, this is step 2. In step 2, what do? We just perform a simple calculation, which it has 3 columns. We want to know the position of net asset of subsidiary at acquisition, at reporting date. Question. What if parent is the seller? It's a good question, and the answer is please wait. Sir, you always make us wait so much. Just wait. Inshallah, you will get the answer. Don't worry at all. So don't worry. Just have little bit patience. Sometimes the student, they become, elder just by waiting. They become old. But don't worry. The wait will be less this time. This is working 2. Now let's go for working 3 is goodwill. Step 3. Working 3, step 3 is goodwill. Okay. I'm just assuming, okay, that this value is 1000. I'm just assuming, please. Goodwill. Now, you have to take cost of investment of parent. Then we simply take NCA at acquisition. Let's say make it easy. Fair value of NCA at acquisition. Whenever it is a full goodwill method, and most of the time, students, please be mentally prepared. I'm not saying always, but most of the time you will face a full goodwill method. But partial goodwill is allowed by IFRS 3, okay? Okay. If it is a full goodwill method, which is more likely to be, examiner will give you the fair value of NCI. If it does not give you the fair value of NCI, then examiner will give you the enough information to calculate fair value of NCI. Okay. Now, simply deduct fair value of net assets at acquisition. And you will get this figure from working 2. And let's say it is 1000. This value. Now you will have goodwill at acquisition. If there is any impairment in the goodwill, we'll deduct that impairment. Impairment loss in goodwill. You will get goodwill at SOFP date. So that will be the goodwill which you have to show in statement of financial position. Okay. Look at this. If full goodwill, then fair value of NCI will be given to you. If not, then examiner will definitely give you the enough information to calculate fair value NCI. But there is a possibility that instead of full goodwill method, you are having a partial goodwill method. You are having proportionate goodwill method. So if your examiner says that we keep NCI at the proportionate of the net asset of substrate. So what I want to say, instead of full goodwill, if rare chances, but chances are there, partial goodwill comes. So in case of partial goodwill, how will you calculate this fair value NCI? Very easy. I'm just giving you the example, okay? Assuming we are solving a question for a partial, and it's a partial goodwill method, how will you calculate a fair value NCI? Just write NCI at acquisition or fair value NCI, no issue at all. Assuming, okay, parents holding is 80%, so NCI holding will be 20. I'm just assuming for the sake of format. It is a full goodwill, it is a partial goodwill method, and we have to find out the fair value NCI. Just do one thing. Take the value of net assets at acquisition, which is 1000 over here, into NCI holding. This is how you will calculate fair value NCI if it is a partial goodwill method. So in case of partial goodwill, how will you calculate the value of NCI at acquisition? Just NCI percentage multiply by fair value of net asset at acquisition. And if it is full goodwill method, if it is a full goodwill method, then examiner will give you the fair value NCI. If directly he is not giving you, then he will give you the enough information to calculate that value. I hope it is clear to everyone. What should be done in case of partial goodwill and what to do in case of full goodwill? Student, please reply. I hope this is clear to everyone. Okay, that's great. Now, step 4, working 4, that is non-controlling interest. Non First of all, you will take fair value NCI at acquisition. Fair value NCI at acquisition. It will be the same value which you have used in working 3 in goodwill calculation. So fair value NCI, from where it will come, the value which you have used in goodwill calculation, that is the fair value at an acquisition. Now what? Now simply we have to give share in the net asset of subsidiary in the post acquisition. So simply add share of net assets in post acquisition. Now, from where we are going to get this? Let me show you. Go back to working 2. In working 2, assuming, I'm just assuming, please, that this column is having a value of $100, 100 million. This last column. So let's say parents holding is 80, so NCI holding is 20. So in the post acquisition net assets, they have increased by 100 million. So definitely 20% of this belongs to NCI. Now, if it is a full goodwill method, number 1, and there is an impairment loss, then less NCI percentage of goodwill impaired. Goodwill impairment. But it is only applicable if it is only applicable if question is on full goodwill, because in case of full goodwill, we know that one portion of the goodwill belongs to parent, another belongs to the NCI. In full goodwill only. Obviously, if it's a partial goodwill method, then in partial goodwill, the entire goodwill actually belongs to parent. The final answer will be NCI. This NCI, whatever the value comes, it will be shown in SOFP. So NCI to consolidated SOFP. Okay. Step 5. No, step 5. Simply, you can use the heading retained earnings or group reserve, both are acceptable. If someone uses the heading group reserves or the retained earning, you can use any one of them, okay? First, take parents' retained earning. Parents' retained earnings at SOFP date. Then simply add share in post reserves of each subsidy, because it is possible that you are having more than one subsidies. Add share in post reserves of each subsidiary. It could be S1, S2. Now, from where will you get this value? From working two. Remember, in working two, in the post acquisition column, we had answer 100. Let's say parent holding is 80%, so 80. So for each subsidy, you have to take share in post reserves. Okay. Now what? Less goodwill impairment loss. Either it is a partial goodwill method or a full goodwill method. Obviously, if it is a full goodwill method, then you have to just take the impairment loss which belongs to parent. For example, let me just explain. Less goodwill impairment loss. Now try to understand. If it is a partial goodwill, if the question is on partial goodwill method, then whatever is the impairment loss, entire impairment loss will be deducted. If it is a full goodwill method, then whatever the impairment loss has come, take that impairment loss, multiply that impairment loss with the parent's holding. Repeat, if it is a partial goodwill method, whatever impairment loss you have calculated, simply deduct that. If it is a full goodwill method, then what are we going to do? We'll take impairment loss in goodwill, multiply by parent's holding. I hope it is clear to everyone. Less. Now, it is possible. It is possible that during the year, after basically acquisition, there were intra-group transaction, and this time, let's say it is possible the parent was the seller. If parent is the seller, then unrealized profit will be deducted from here. Less unrealized profit. Now, unrealized profit could be on a stock, it could be on machinery, whatever parent has sold to the subsidiary. So less unrealized profit if the parent was the seller. So I hope I have answered one query. Now what else? If, now listen and listen carefully. See, it is not necessary that all the time you will be having a positive goodwill. It is possible that instead of positive goodwill, you are having a negative goodwill. The name for the negative goodwill is gain on bargain purchase. Either it is a partial goodwill method or a full goodwill method, whatever is the amount of the gain on bargain purchase, entire gain on bargain purchase only belongs to the parent. Gain on bargain purchase is simply the gain for the parent. If it is there, gain on bargain purchase, another name is a negative goodwill. So simply add. If you have, okay, please, gain on bargain purchase. That is, you can say, a sophisticated name for the negative goodwill. Okay. Normally, you will have these 5 steps, but there's a possibility that you might be required to perform a calculation for the other component of equity as well. If it is required, no issue at all, then go for working 6. Other components of equity. Okay, first take parents, other component of equity. On SOFP date, okay? On SOFP date. Then simply add share in post acquisition other component of equity of each subsidiary. Add each subsidiary group share of post acquisition. Other component of equity. If it is there, then you will find this value also from working to. If there is any difference in the post acquisition other component of equity, you will get this value also from working to. For example, let's clarify here. Working to is here, okay? Other component of equity, look at this, just a minute. Let's say other component of equity at acquisition it is 40, at reporting date it is 50. So obviously it is 10. Now try to understand. Assuming this comes, the total is 110 and this one in this 110, 10 belongs to OCE. So it means you will not, when you will be giving, when you will be actually working for parent, when you will be working for parent, when we'll be calculating retained earning for the parent, we will take 100. When we'll be calculating OCE for the parent, then we'll take 10. But when I am calculating value of NCI, then entire 110 will be considered. Only for the parent, you have to be careful because for parent, other component of equity, you have to calculate separately and retained earning, you have to calculate separately. But obviously, when I'm calculating NCI, so I'll take entire 110 into NCI holding. When I'm calculating parents retained earning, group retained earning, then I have to work on 100 separately and other component of equity I'll take separately. Is this clear to everyone? When you are working for NCI, take entire 110. When you are calculating parents retained earning, when you are calculating just retained earnings, group reserves, then you need to work on, for the retained earning, you need to work on 100 and for OC, you need to work on 10. I hope this is clear to everyone. Yes or no? Please reply. Please, if it is decreased, so it will be negative. It should not be an issue. Please look at this. Assuming, let's take it like this. It is 60, it is 50, and we are having a negative 10. And due to negative 10, assuming, just let's work. The final answer is 100. Okay. When I'm working for NCI, I'll take entire 100 into NCI holding. The job is done. When I'm working for parent, for retained earnings, students, please try to understand. Logically, I'll take 110 into parents holding. And in OCE, I'll take negative 10 and parents holding. Is this clear to everyone now? If negative comes, what to do? Okay. Yes, simply great. Okay. Now one more working. Let's say we are preparing consolidated associate. So how do we calculate value of NCI? Basically, you have to give share in NCI profit. You have to give share to the in subsidies profit. You have to give share to NCI, as well as in subsidies total comprehensive income. You have to give share to NCI. How will you calculate that? Now I'm talking about consolidated associate. And how do we deal with NCI? Profit. Obviously, you have to take subsidies profit and subsidies total comprehensive income. Subsidies profit and subsidies total comprehensive income. So let's take profit slash total comprehensive income of the subsidiary. Put there. Now, you need to deduct unrealized profit if subsidy is the seller. You need to deduct unrealized profit if subsidy is the seller. If subsidiary is the seller. But please remember, now we are working for consolidated SOCI. Only current year intragroup trading impact comes here. There's a possibility that 2 years back, subsidy sold a machinery to parent. So that unrealized profit on the machinery cannot come here. Right now, we are working on consolidated SOCI. So make sure you will only consider the unrealized profit on the transaction. They relate to the current year, intragroup trading. Okay. What else? Simply deduct additional depreciation, additional amortization on fair value adjustment. Additional depreciation slash additional amortization on fair value adjustment. Now listen carefully. If it is a full goodwill method, in that case, deduct goodwill impairment loss. Again, current year goodwill impairment loss, because it is possible that you might have acquired a subsidiary 2 years back. While calculating consolidated, when doing basically preparing consolidated SOFP, then you have to take impairment loss for the 2 years. But P&L SOCI is just for the current year. So you have to deduct goodwill impairment loss. Number one, the goodwill method has to be a full goodwill method. And second, if there is any impairment loss in the current year. Goodwill impairment of current year, okay? It is only when full goodwill method. In case of full goodwill method, I'm assuming that we are having 80 and this is 90. Just an assumption, okay? Now simply multiply with NCI holding. Let's say NCI holding is 20%. So you will get profit slash total comprehensive income attributable to NCI. Attributable to the NCI. Let's say this will be 16 and it is 18. I hope this is clear to everyone. Yes or no? Please, student, reply on this. And you have to give me just 4 to 5 minutes break. Then we are resuming from here, inshallah. Just 4 to 5 minutes break. Thanks a lot. Parent and associate. So nearly we got saved. Thank you. Otherwise, there wouldn't be any recording. Okay, parent and associate. Associate means where parent is having, let's say, holding, generally speaking, between 20 to 50%. But obviously, it is just one of the, I would say, criteria that parent is having holding between 20 to 50%. In addition to that, another concepts are that you will be having a significant influence in that company. Significant influence means at least you can say there will be one directorship chair. If this is not the case, then let's say whenever, then this, and let's say you don't have a directorship chair, it's okay. There's a possibility that whenever your associate needs a technical support, then you send your entire technical team over there. So whatever that technical matters are, in that case, again, we'll say that you have a significant influence in that organization. But most of the time, we say that significant influence can be identified, can be determined on the basis of a directorship chair. Okay, now listen to me carefully. When you are dealing with associate, so logically there are two approaches, both are acceptable. But nowadays, we go towards a simple approach rather than going towards consolidated approach. I'll share both the approaches with you. But after that, let us just stick to one approach, and I'll be inclined, I'll be more in the favor of simple approach rather than the consolidated style approach. So let's see. We are talking about parent and associate. Let's see. Simple approach. Let's say sale of inventory. Sale of inventory. And let's say parent sells to associate. Okay. In simple approach, what do we do? In debit and credit, we will debit retained earnings, or you can say group reserves, obviously with parent share. Retained earnings or group reserves, whatever you say. Retained earnings. That is share of associates profit. Let us bring the value so that it will be easy. Debit the retained earning, and you will simply credit investment in associate. Investment in associate. And we are discussing simple approach. Let's say parent and associate. Assuming parent sold 100 million stock, the stock which was having a carrying amount of 100 million, parent sold this to associate for 140 million. Okay. Parent's holding is, let's say, 30%. And let's say entire 140 entire stock is unsold. Entire stock is unsold. We know that unrealized profit is always in remaining stock. Unrealized profit is always in remaining stock. And for the sake of just format and simplicity, I'm assuming entire stock is unsold. Since the transaction is between parent and associate, so what are you going to do? We know that parent has sold 100 million, the stock which was having a carrying amount of 100, sold it for 140. So parent has recorded a profit of 40 million. But you cannot eliminate entire 40. Parent's holding in associate is just 30%. So we'll take 30% of this, which is 12 million. So simply retain earning, debit, investment and associate credit. Now listen, let's say again, sale of inventory, associate sells to parent. Don't forget, we are discussing simple approach, debit and credit. Again, the same double entry, retain earning debit, investment in associate credit. Again, let's say everything is same. Now associate has sold 100 million stock, having a carrying amount 100 million, sold it to parent for 140, assuming entire stock is unsold. Again, you will take 40 multiplied by parent's holding, retain earning will be debit, investment in associate will be credit. Is this clear? This is a simple approach. In simple approach, you will always, with the unrealized profit, you will always debit the retained earning and always credit investment and associate, no matter whoever is the seller. Okay. Even, let's say, sale of property, plant and equipment. Parent sells to associate, no issue at all. We'll take unrealized profit according to, again, obviously parent's holding, and look at this. We'll debit the retained earning. Credit will always be investment and associate. Now, either associate sells to parent or parent sells to associate. I hope this simple approach is clear to everyone. Yes or no? Just debit the retained earning, credit the investment and associate. And let me tell you, this simple approach is, number one, it is acceptable, and number two, nowadays majority is using this simple approach. Just for the sake of knowledge, I'm just giving you the idea of the consolidated style approach, but I would say, I would recommend, please, you should stick to the simple approach. That is easy to tackle. But it will take hardly 1 minute. No harm to discuss the consolidated style approach. Consolidation style approach. Sale of inventory. Sale of inventory. Parent sells to associate. Who is the seller? Parent. Look at this. Debit, credit, retain earnings, investment and associate. You might be thinking it is same. No. Wait. Investment and associate. Remember, parent is a seller. Now, sale of inventory. Associate sells to parent. Associate sells to debit and credit. Retain earning. Now, credit will be inventory. This is the difference. I hope you can see the difference. Look at this consolidation style approach. You can see that when associate becomes the seller, then there's a difference. And let me repeat, both the approaches are acceptable, but it's better to go to use simple approach. You will get 100% marks. Because simple approach, I have not given you. It is given by the IFRS 3. And it is 100% acceptable. If it was not acceptable, why would IFRS 3 will give us this simple approach? So I hope that simple approach is simple. Yes or no, students, please reply. And I've given you the comparison as well. The consolidation style approach and simple approach. I think you can compare it. So that comparison, again, it is going to help you also. So it's better that we should stick to simple approach rather than in any other approach. Okay. Now, students, in today's class, I just wanted to discuss few basic formats which I have discussed. But inshallah, we'll be having a class tomorrow as well, because now obviously we have to have the classes. So in tomorrow's class, inshallah, we'll be discussing further formats, plus there's a possibility we might start consolidation also, or questions. If not, then after tomorrow we'll start the questions as well. But don't worry at all. You might have observed today, we have discussed all the basic formats today. So we'll be inshallah discussing the entire I'll give you the revision of the entire consolidation, all the topics which I have mentioned. So thank you very much. Keep revising. And student, I'm planning to keep your mock on Sunday, coming Sunday. Is this okay? Sunday is perfect, I believe. Sunday is okay, because so get ready for the mock as well. And please, mock is something else and this revision is something else. Please don't wait for this revision. So get ready for the mock. I'll ask the admin to share the words message with you. Otherwise, I'll update each and everything. Today is a little bit late in the morning. So you will get all the updates in your WhatsApp group. So see you all tomorrow, inshallah. Timings, everything will be shared in your WhatsApp group. So have a nice life. Please keep revising, revise, and you need to practice, practice, and practice. Thank you very much for coming up for the live revision class. Thanks a lot.